Hello, Wayne.
Hello, Victoria.
I've just started looking into the US stock market, and everyone keeps talking about dividends. Can you explain what a dividend actually is from the very basics?
Of course, at its simplest, a dividend is a share of a company's profits paid out to its shareholders. When you buy a stock, you become a partial owner of that company. Throughout the year, the company operates, generates revenue, and clears a net profit. A dividend is when they take a portion of that cash and distribute it directly to investors based on how many shares they own.
So the company is literally sharing its earnings with me. Do they just deposit this cash into my account?
Exactly. You don't have to do a thing. When the dividend payment date arrives, the cash is automatically deposited into your brokerage account. Your shares stay exactly where they are, but they generate steady cash flow just for holding them.
That sounds amazing. Does every company on Wall Street pay dividends?
No, and that's the most important part to understand. U.S. companies generally fall into two categories: dividend payers and non-payers. Dividend payers are typically established, mature giants that dominate their sectors and have incredibly stable, predictable cash flows.
Like the massive blue chip companies, who are some of the biggest examples?
Coca-Cola is the ultimate classic. They are what we call a dividend king because they've increased their dividend every single year for over 60 years straight. Other massive examples include Procter & Gamble, Johnson & Johnson, and even tech giants like Apple and Microsoft. These companies are already so massive that they don't need to reinvest every single dollar into aggressive expansion, so they reward shareholders with cash instead.
What about the companies that don't pay dividends? Are they a bad investment? What do they do with all their profit?
Not at all. They just have a different strategy. These are growth-oriented companies. Instead of giving that cash back to investors, they reinvest 100% of their earnings into research and development, building new infrastructure, or acquiring other businesses to scale up as fast as possible. Think of Amazon and Tesla. For years, they never paid a single penny in dividends. Instead, Amazon poured billions into building its global logistics network and AWS cloud infrastructure, while Tesla funded its massive gigafactories. Even Google and Meta went decades without paying dividends, only initiating their very first dividend payments recently after accumulating massive cash reserves that they couldn't possibly spend all at once.
I see. So if a company doesn't pay a dividend, investors aren't looking for steady cash flow. They are betting that the company will grow so much that the stock price itself will skyrocket. The profit comes from capital gains when you sell.
Pot on. With a growth stock, you buy at $50 hoping to sell at $500. With a dividend stock, you don't want to sell at all. You keep the stock in your portfolio, and it acts like a rental property, sending you regular rent payments. Wall Street calls this passive income.
It all makes sense now. Could you give me a few specific company names or tickers for both sides so I can start researching them to invest?
Absolutely. For reliable dividend payers, you should look into tickers like Coca-Cola, PepsiCo, Realty Income, which actually pays dividends monthly, and Johnson & Johnson. For high-conviction non-dividend or growth stocks, keep an eye on tickers like Amazon, Tesla, Nvidia, which pays an incredibly tiny, almost negligible dividend because they reinvest everything into AI chips and Netflix.
This list is perfect. A mix of high-growth tech stocks and steady, reliable dividend payers sounds like a great way to start a balanced portfolio.
Exactly, Victoria. That's the core of diversification. But remember, what I just gave you is not investment advice. You must thoroughly research these companies and look into their financial health deeply.
I have a very specific question. If I have $50,000 ready to invest and I invest all of it in the dividend-paying companies you recommended, how much would I actually earn?
To give you a clear picture, let's run a simulation using 4 of Wall Street's most famous dividend giants, looking at what a full $50,000 investment would generate in each one individually so you can compare them. First up is Coca-Cola. With a stable dividend yield averaging around 2.9%, putting all $50,000 into KO will pay you exactly $1,450 every single year in pure cash. Your core $50,000 stays safe in the stock and you just collect the checks. If you choose its biggest competitor, PepsiCo, the numbers jump a bit. Pepsi typically offers a slightly higher dividend yield, hovering around 3.9%, meaning a $50,000 investment here will reward you with a hefty $1,950 annually. If you prefer a massive defensive sector like healthcare, look at Johnson & Johnson. At a 2.8% dividend yield, your $50,000 investment will generate $1,400 per year. Because they have increased their payout for over 60 consecutive years, that $1,400 is highly likely to grow over time. Finally, the heavy hitter for monthly cash flow is Realty Income. This is a real estate investment trust with a much higher yield, averaging around 5.6%. If you put your $50,000 into ticker O, it will pay you a massive $2,800 a year, which breaks down to about $233 every single month, dropping straight into your account on autopilot. In addition, fluctuations in stock prices also affect profits. Let's look at the exact percentage moves for these four dividend giants over those specific 12 months. First up is Coca-Cola. Between June 2025 and June 2026, its stock price climbed from around $70 to $80, marking a solid 14.2% increase in capital growth. Next is its biggest competitor, PepsiCo. Pepsi also had a positive year, moving from roughly $131 in June 2025 to around $142 in June 2026, locking in an 8.4% increase in share value. If you look at the healthcare sector, Johnson & Johnson was an absolute rocket. It surged from around $152 in June 2025 all the way up to $228 by June 2026, which is a massive 50% increase in stock value. Finally, Realty Income, the real estate giant, also performed well. Its share price climbed from around $57 to $62, gaining about 8.7% over those 12 months.
What about the companies that don't pay dividends? How did their actual stock prices perform between June 2025 and June 2026 in terms of percentage growth?
Of course. First, Nvidia continued its massive run, climbing from around $144 in June 2025 to over $200 by June 2026, which is a staggering 39% increase in stock value. Next, Amazon showed steady market dominance. Its share price moved up from around $219 to $233, marking a solid 6.4% gain for the year. On the other hand, Meta Platforms experienced a sharp correction after hitting historic highs in 2025. Its stock dropped from around $738 in June 2025 down to $563 by June 2026, resulting in a 23.7% decrease. Finally, Tesla had an explosive recovery. After trading around $317 in June 2025, it charged all the way up to $381 by June 2026, locking in a beautiful 20.1% increase in share value. Happy investing.
Thank you.